All right, everyone. Well, I'd just like to welcome everyone to our first CHU webinar of 2023. So my name is Craig Stanley and I'm the National Business Development Manager with CHU. And today our Chief Customer Officer, Arnie Kakulapati, will address the extremely relevant topic of the state of the strata insurance market. And he'll actually look at why insurance premiums are currently increasing and what our clients can actually do to help minimize those increases in future. Now today, I'm actually doing this from Darwin and Arnie is doing this from Brisbane. So I'm doing it from the land of the Larrakai people and he's doing it from the land of the Turrbal people. Now, in the spirit of reconciliation, CHU acknowledges the traditional custodians of the land on which we live and work throughout Australia and their continuing connection to land, sea and community. We pay our respects to their elders, past and present and emerging, and extend that respect to the Aboriginal and Torres Strait Islander people. Now, I'd just like to pass on to Arnie to do the state of the strata insurance market. Thank you.
Thanks, Craig. Hope everybody can hear me. Welcome. So, welcome everybody. Thank you for taking time out of your busy schedules to attend this session. Most of you probably know who we are and what we do at CHU. For those who are new to Strata World, welcome, because there have been a lot of new faces in the industry across the country, which is fantastic to see. But for those new faces, allow me to tell you a little bit about CHU and its products, services, and most importantly, why you should choose CHU. We have a long and a progressive history. CHU arranged the first strata residential plan in Australia 45 years ago in Sydney, and we offer a wide range of products. Our 24/7 claims processes an emergency hotline, and we write over 1 million properties are protected at CHU, and we are a multi-award winning company as well, which we are very, very proud of. In terms of what products and services that we offer, majority of our business is residential strata. We do offer commercial, landlords, contents, and then we have build to rent and community association, and our sister concern, Flex Insurance, which is the most flexible product in the market. In the recent past, we've started CHU services as well. Our CHU Assess is probably the oldest of the three, which has been there since 2017, and it's growing every day. And we do have a consulting arm, and we recently started CHU Inspect as well. That's enough about us. So what are we here for today? The agenda. I'm going to talk about state of the market, state of the strata market, and also the insurance market is very similar as well in 2023. I'm going to talk about responsible pricing and clients' best interest. So the premium drivers, premium growth versus cost of claims, the catastrophe weather events that we've been seeing in the last 12 months and beyond, premium building blocks, how premium is actually calculated within the strata world. And I'm going to touch a little bit about the reinsurance pool and the relationship between excess and premiums. And we're also going to talk about how we need to change our mindset and start looking beyond the premium. So we'll talk about all of that in this session. Okay. What is the state of the market at the moment in strata? What are the factors that drive the premium? How the premium growth is compared to cost of claims that have been growing every day. What impact does we have, not only as a strata industry, but also as an insurance industry with the increasing catastrophic events that are happening across the globe? The premium building blocks, how you actually calculate premium when it comes to policies. The increased reinsurance cost, which is a major factor which determines how much we should sell a policy for. And the technology that has been developed in the recent past, which is growing every single day, we can get into the policy level factors which influence your pricing. Let's start with the current drivers of premium. Increased claims cost. So we all know, it is far more expensive than what it is in the past to fix. Whether you call COVID a reason, whether you call the war in Ukraine, shortage of labor, shortage of skills, shortage of materials, everything plays a part, and that kind of is making the cost of claims going up every single day. And we mentioned about increasing catastrophic events, and this is set to continue. Just to give you some stats, if you take that into a 10-year blocks, the rate of catastrophes that are happening across the globe are increasing very, very, very rapidly. So, for example, if we had 150 catastrophic events in between 2010 and 2000 and 2010, now between 2010 and 2020, they've gone up to over 600 events. So the combination of all of this is making sure the premiums are growing as well. The increased reinsurance costs. So this is a very, very important factor, and I'll touch a little bit about what reinsurance is in the future slides. But these costs add to the premium increases, and as the name suggests, reinsurance, it's the insurance for insurance companies. And underwriters using high quality data. So this kind of work both ways for people, for buildings which we were charged a bit more with this accurate pricing, some of them will get charged less. Buildings which were getting charged less with this accurate pricing, the cost will be more. So there are so many factors that drive the premiums up, and I'm going to touch on some of them because we can't cover all of them. So if you look at the increase in claims costs versus the sum insured, as we talked about how building costs are growing every day and going up, this is a huge thing at the moment, and I want all the board corporate managers on the session and the brokers to have a look at it. The growth of sum insured is nowhere near where it should be in terms of claims costs and also the construction costs. So if you look at those graphs there, the blue one is the CPI, the orange one is the house of construction inputs, and the green one is the sum insured change within the CHU book. So if you look at it, we should be looking at 14 to 16% increase when it comes to the BSIs because of the costs in construction. But if you look at the graph, the CHU average change is actually around 4% or just a little bit over 4%, whereas the CPI is around 8%. So, as you all know, as underwriters, we can't really tell you how much you should insure your building for. But in respect of legislation in your state, we highly recommend to get valuations done pretty regularly so that, your clients are not underinsured. And then, God forbid, if there is a total loss, they're not out of pocket. So this is something that we all should keep an eye and encourage our end clients to get valuations done regularly. So this is another graph which actually tells you about the premium growth versus claims growth in Strata. So in the last 8 years or 10 years, the growth rate of premium is not in line with the claims cost. There are a couple of reasons for this. The premiums were eroded by the competitive market that we had in 2015 and 2017, where we had some new entrants into the market. And then that did not have any impact on claims inflation. So the prices were probably, went way too down, which were not sustainable. And then all the other factors we discussed so far made the impact even more when it comes to premium increases. So for example, a policy which should have been sold for $100 in 2015 and 2016 probably was sold for $40 or maybe $50. And suddenly, with insurers not making any profits, the pressure is on underwriters to make sure we get back to the technical premiums and we sell the product at the price that it should be sold. So the catching up of that had COVID and the war. It's actually making it really, really difficult for end clients to accept some of the increases that you're getting. But at CHU, we've kind of tried to minimize this impact, but having said that, you will still see policies which 20-30% increases, and there is a reason behind why they get increases like that. So at CHU, we've divided the whole portfolio into 10 deciles. Say for 1 to 5, your increase probably will be 0 to 7.5%, and then 5, 6, 7 will be around 10, above 10. 8, 9, 10 are the ones which will have 20, 25, 30%. And the simple or straightforward reasons for that increase is how far away the policy is from the tech price. And the point about tech price is that goalposts with tech prices keep moving as well. So we need to keep that in mind as well. And how far it is from tech price, what is the construction, and how well the building is maintained, and what are the claims that you have on that particular policy will influence the pricing of that. So keeping all of this in mind, CHU is trying our best to make sure our prices are sustainable and there are no knee-jerk reactions. When we tell you why the price has gone up, most of the times we try to explain the reasons why it has gone up. But if you look at the whole portfolio itself, there is about 14% of CHU's portfolio which is actually rolled over, or maybe around 5%, which I feel, for most of you on the call, it's hard to believe, but that's actually a reality. So there is a percentage of the book where you get premium increases in 20s or more than 20%, but there are parts of a lot of our book is still around 10 to 20% increases. So just to give you a little bit of an idea of the increase in catastrophic weather, if you look at that graph, the Australian natural catastrophic claims cost in 2022, it is directly related to the Australian Actuaries Climate Index. So if you see the amount of bushfires and earthquakes and hailstorms and storms and flooding and cyclone, all of these things have increased a lot in the last 10 years. And that is definitely going to have an impact on how we price our policies and what is the end customer will be paying for these policies. The climate change is impacting, and the frequency and the severity of insurance events is increasing. And we've all seen the exaggerated La Nina. So the pricing models are scrambling to get up to date. So this is what I said before. When we talk about the tech prices, the tech price that we want to achieve this year will be influenced by factors that we just discussed, and the goalpost will move. And then that way, we try to be as sustainable, as consistent with our pricing as possible. But the reality is, in 2023, we all should be looking at the availability of insurance rather than the affordability of insurance, which is something that we need to consider when we're talking to our clients, because I'm sure a lot of you on the call would say, a lot of times CHU is probably the only company who will come to the party. So if we are trying our best not to decline our renewals and try and write the risk the way we should, I want all of you to understand we are trying our best in terms of price as well. So I would say the affordability, the word affordability in the next 12 to 18 months, especially in Strata market, is something that probably won't have a lot of significance. It's the availability is the word that will have a lot of importance. So speak to your underwriters at CHU, speak to your BDMs at CHU. We're more than happy to sit down with you and discuss what we can do and what we can't do. But the honest truth is CHU may not be able to come to the party all the time, but we will try our level best to be there with you, work with you, help you in difficult situations. So how does the catastrophes affect premiums? So if you look at the premium building block of a residential strata, so this is basically how we kind of put in a typical policy. So the average premium is what's being considered here. The average premium of a policy is around 3,500, 3,600. So out of that, we kind of take, say, $438 for more frequent events. The flood premium would have $109, hail $315, and other figures that you can see. But if you see there's earthquake. You might be thinking, how come earthquake has got a big chunk of the building block? Because the reason behind that is, yes, the frequency, touch wood, is very low when it comes to earthquakes. But if an earthquake happens, it's not going to be like a burst pipe claim, which happens only in one building, even one unit in a building. If an earthquake happens, there'll be huge losses, and there'll be a lot of total losses, and it will cover a big area as well. So the robust accumulation for those low frequency, high severity events is very, very important. So that's why, people might say, no, I don't need flood here. The reason for that is up to 10B with our flood rating zones, the flood is mandatory. After that, it's optional, and once it hits a flood zone of say 60 or something, we won't offer. But the reality is we kind of accumulate, or when I say we, the insurance premiums, the building blocks are done in a way where every policy will have all this accumulation of cost or premiums built within that, because it's the reason how you compensate. So people in, say, I'm in Queensland, so north of Queensland actually feel, why our insurance prices are so high compared to down south. We didn't have any events in the last couple of years, and why are we paying still a lot more than our Sydney or Melbourne? And the reason is actually described in here. So the reason is, if there is an event in North Queensland, the chances of having big losses is a lot more compared to the other areas of Australia. So that's one of the reasons. And same thing, availability versus affordability. So there was a Macquarie report recently, or a couple of years ago, that came out. So their calculation basically says, even before an underwriter or an insurer enters that market, they're losing 19 cents in every dollar. So, some of you, or a good portion of this group that are attending this session are business owners. We all know, we do business to make profit and, of course, provide a great product and great service. Would you do something that's going to cost you money? That's a question we all should ask before we come to conclusions around why people are not helping. All right, national claims costs versus state claim costs. I'm not quite sure if you can see that graph clearly. I hope you do. So the national thing is on the left, and it's the state divisions in terms of how much it's actually is happening in other states is on the right side of that slide. So if you look at the non-cat claims, the other storm, they're all kind of divided differently in every state. So the regional and state variations do exist and are factored in rates. So also the costs come back to CHU as a single entity under a single binder. So we have to maintain a profitable book to ensure strong backing going forward, and also the costs are shared nationally. So when I say this nationally, it's kind of, that's where you see different prices in different states. And I'll talk a little bit about the policy pricing at a policy level. Now you might find a lot of instances within your portfolios where two buildings are looking exactly the same. They're right next to each other, but one building gets charged more than the other. So the sophistication within the technology is actually is really, really good, and it's improving every day. The reasons for that is they're taking factors that are not visible to your eyes, but their calculations and their technology is kind of driving these prices. All right. I did say that I'll talk about reinsurance costs and how they impact the pricing. So, as I said, reinsurance is insurance for insurance company. And why are the reinsurance costs going up? No single insurer can cover these catastrophe events. It's reinsurance is also required by APRA. It's designed to smooth low frequency, high severity catastrophic events and small cost each year. So we talked about the earthquake as an example, floods, all of these things. But those things for us to still survive and pay the claims that we should pay, we do need reinsurance. And as I said, it's also required by APRA. And the reason why reinsurance costs are going up are pretty obvious. Most of you probably have to just look out of the window and you know why it's going up. Increase in catastrophic events in Australia, bushfires, floods, hailstorms, they all affect the price of reinsurance. The reinsurance costs are continuing to rise, and this is ultimately will be paid by the end user. So we have at CHU has already factored much of these increases. As I said, our aim is to make sure there are no knee-jerk reactions. There are no, surprises in terms of saying that okay, the whole book is going up by 50%. That's not what we want to do. And the other reason is, Australia is not a favorable market for reinsurance companies because the size of the land that we have and the population and insurance buying capacity that we have doesn't add up to their numbers, and it's not a favorable market. So they probably it's very similar to example that I've just given you in terms of saying if you have a choice as an insurer or an underwriting agency, the honest truth is you'll try and avoid areas and places where the frequency of claims is high. And as a country, Australia is not very appealing for people to come and do business here for insurance. Okay, let's talk a little bit about the policy level factors that are affecting the premium. And this is a big thing across the country, but more so in New South Wales, cladding and ACP defects, the hazards that we have, claims history, we talked about location, if it comes to commercial, the occupancy. All of these individual property factors will be considered and the premium will reflect on what it is. So we will discuss about the things that you can do proactively to reduce these impacts, but these are the major factors that we consider when we're actually pricing a policy. So, what to expect in 2023? The average rate change for Strata renewals is going to go up. And we talked about the heavy discounting that happened in 2015, 2016, and 17 is actually now got to a point where the costs are looking a lot more than what they should feel like. The inflation, reinsurance cost, and CAT costs, we already talked about that. The higher rate changes average than last year. And as I mentioned, this is not for the whole book. This is something that we've factored in, and that's why I spoke about the deciles that we do at CHU. So speak to your BDMs. We can actually talk to you about where your portfolio sits in terms of the coming renewals, how much of an impact, if you have, say, 15 or 20 or 100 or 200 renewals coming up in a month, how many of them are actually fitting 8, 9, 10, how many of them are between 1 and 7. So we would love to have those conversations in advance. And if there are any problematic buildings where, offering a renewal is an issue, please speak to your BDM. We'll sit down and we'll work with you in advance. So targeted rate changes, minimum and change for well-priced policies, but harder policies with claims. The impact on claims volume, the changes that we've seen will be 21% more than what we're doing in the past and far greater than claims costs. So our claims team are trying all their best to make sure we can provide exceptional service. But at the moment, like every other business and every other insurer and underwriter, we are under the pump when it comes to claims. So this is more, the next couple of slides is more Queensland centric, I would say, but I think there's some really good information for other states as well. So let me talk to you a little bit about the Cyclone reinsurance pool. So for those who haven't heard about this, I will tell you what it is. For those that you've heard about this, I'm just going to touch a little bit on how this is going to affect CHU policies. Firstly, what is the Cyclone reinsurance pool? It is set up by the Australian government. It's aimed at improving the affordability and accessibility of insurance in cyclone-prone areas. It transfers cyclone risk from insurance to the pool. It's administered by ARPC, and it's backed by $10 billion government guarantee. So what's included in this reinsurance pool? Cyclone and cyclone-related flood damage, home, strata, and small business insurance. So that 10 billion is just not for strata, it's for home, strata, and small business insurance. For flood, from the time the cyclone begins to 48 hours after it ends. So what does this mean for strata? Residential strata, commercial strata with less than 5 million total sum insured. Mixed use schemes where at least 50% of floor space is residential. So when is this going to start? The participation is mandatory for large insurers by December 2023, for small insurers by December 2024. And you all must have seen before the release of the government modelling, there were figures getting thrown saying there'll be 58% discount for strata properties, there'll be this, there'll be that. Sorry to be a bad news bearer, I don't think that is the case. So the ARPC modelling say the potential impact of this pool, average across Queensland, NT, WA, and New South Wales will be around 14%, and the greater average impact up north is 37%. As I said, this is in isolation of the current cost pressures. Premiums will be lower than they would otherwise have been, but the pricing headwinds are still pushing against them. So let me repeat that again. This is the potential impact according to ARPC modelling. This is not CHU's pricing. When talking about pricing, responsible pricing. Let's touch on this topic. We're correcting the market, responsible pricing, pricing in more detail, a proactive approach. The starting point for this is, we don't want to come off risk. We will work hard with our brokers, strata managers, and direct clients to find a solution. The prices that are going up, north of 30% or something, we'll work with you, whether it's a short-term policy, agreeing action plan for remediation, using of excess or special terms, keeping in mind under PDDO, all of that, we'll work with you. But what we request from you is we need to get a buy-in. We need to see some action, whether it's strata managers, whether it's the owners corporations. We want to, see them demonstrate a real intent. It's not often that we say no. Probably we are saying a little bit more than what we used to in the past, and we've talked about the reasons for that. Usually, the no is a result of a very poor risk, with issues not being addressed by OC. Open claims, defects, lack of maintenance, and you turn on the news nowadays, you'll see something or the other being collapsed somewhere in the world with these things. So, with underwriting due diligence that we have to do, the insurance is highly regulated, and clients' best interest is paramount. So, duty not to misrepresent, provide terms fit for purpose, must sell the policy that meets clients' needs. That's something that has been a big thing in the last 2 years. I'm not saying it wasn't there before that, but now there's so many things that needs to be done. It's very, very important that the right thing is being done by all parties involved in this. So as I mentioned, duty not to misrepresent, providing terms fit for purpose is very, very important. So we do get requests where they say, okay, you don't cover defects anyway, so why don't you write this policy? The honest truth is we can't. We can't give you a policy knowing that there are defects and say defects are not covered. So we need to understand what are they going to do, how proactive they are to do it. And if there is a change in their attitude in terms of saying, these are the things that are put in place to get this done, we're more than happy to work with you and try and provide as many solutions as possible. And, it's who's taking advice from who is very, very important. So who is responsible? Is that general advice? Is that personal advice? We need to be aware of that as well. And at the end of the day, who decides whether they're going to write the policy or not? So I want all of you to work closely with our BDMs if you have any questions around it. And as I said, this question pops up every single day where, oh, well, why can't you just, not cover the defects and write the building for us? We can't. So we are aiming the premium change to be predictable if we can, but aiming to correct the market. We talked a lot about the average claims costs and the premium change, how they kind of not in line. So this is another graph which actually shows the premium index and the average claim size index as well, which there's a huge gap there. This is the latest data, and the source for this is CHU and QBE. So what you can expect in 2023, the last 10-year weather patterns, as I mentioned before, are unusual conditions. These are considered to be extreme. Settling down as normal large losses will continue. So the world events have an impact, and an event in South America will have an impact on the premium that we pay here. And that's how the insurance world works. We need to be aware of the bigger picture in terms of what are the factors that are going to impact the premium, and try and educate our clients as much as possible in being proactive and the measures that they can take to minimize these price increases. So what are factors that are responsible for pricing? We talked about this, the insurance history, the size of the block or the construction of the block, the location, age of the building, is it heritage listed, has it got cladding on it, defects, security and fire protection, flow rating, commercial tenancy, with the commercial policy, it makes a difference who occupies that commercial block. So these are all the factors that are responsible for pricing. So just to give you a little bit more detail about pricing, as I mentioned, the data enabling of more sophistication in the underwriting process. The predictive modeling being used at address level. So, we're all aware of doing underwriting at portfolio level. And when I say portfolio level, it's more kind of saying, okay, the southern suburb in Brisbane, this is the rate that we're going to charge for every building in that suburb. Those days are gone. The modeling has come down to address level now, and that's why I gave you the example of buildings looking exactly the same right next to each other, getting charged different premiums. The modeling combining historical claims experience with external data source. I mean, we have enough data for the last 45 years to actually be better than a competition out there in the market. The factors that are relevant costs, not just claim payments, including reinsurance costs and operational expenses that we spoke about. So I touched on proactive approach, and especially proactive approach to defects. Is many strata buildings have defects. So having the proactive approach to defects will help us to help you better. So be proactive, tackle early, work outside of your renewal cycle. Don't wait for the renewal cycle or the renewal date 4 weeks or 6 weeks in advance to give us updates around what's happening with that building. You don't need to wait for that. You can work outside of renewal cycle and say, give as much time as possible to your client, give as much time as possible for us to work with you to provide more solutions. Monitor the building state of repair on a regular basis. So these things happen come renewal time. We say these are the things that we expect the body corporate or the owners corporation to do, and this will influence how we're going to do, whether we're going to consider renewal next year or not. Most of the times, those things, take a backseat, and come renewal time, that's when we'll go back and say, oh, okay, nothing's happened. So this will make it very, very difficult for us to offer renewal and also for your clients to get insurance. So take small steps more often, and prevention is better than cure. So what are the repercussions for the insured if there's no proactive approach? If the proactive OC reduces their risk of claims being denied due to lack of action, delays, increasing cost of repairs and premium increases at renewal, late or no action places the policy at risk of being declined, and difficulties obtaining multiple quotes. Slowness to act can be seen as a warning bell to insurers. I think, here, the Owners Corporation's attitude towards risk management and unresolved defects such as poor building management practices will have a big influence on us whether to offer renewal or not. So these are the simple things that can be addressed, more often, and be proactive about it and work with us, and we're always there to help you. All right, client's best interest. What can OCs do So I did say that we will look beyond the premium and CHU working with our customers. So what can OCs do? Be proactive, step to manage defects, take small steps more often. As I mentioned, prevention is better than cure. Building quality, maintain timely action, deal with aging, wear and tear, full disclosure of claims, defects, works and repairs to the insurer. Your duty to not misrepresent, avoid declines and claim delays. If there is a problematic building, give us more information. That will make our job easy to provide a solution than saying, that will avoid declines as well. So if we don't get enough information, we normally take the worst case scenario. So the original case probably is not as bad as what we pretend that to be. So as much information that you provide will make our lives easy to provide as many solutions as possible. Obtain correct and up-to-date valuation. So this is something that I want everybody to take away if you can, because getting valuations done in the current market is really, really important. Looking beyond the premium. Premium is often the focus. However, owners should consider multiple factors when finding the cover that is right for them. So as I said, affordability versus availability is something that needs to be taken seriously, at least for the next 12 months. You need to ensure the policy is comparable to their current cover and service standards, insurer history, claims approach. So we've been in the market for 45 years, and our aim is to be there at least for another 45 years. So I would suggest, just don't go by premium. If there are reasons why you should stick to the best service provider, premium should not be the topmost factor that you should consider. But at the end of the day, I do know how much of that influences the decision making. But we need to let our clients know that we need to consider other factors, and we need to look beyond premium as well. And I'm very proud to say at CHU we probably will renew over 95% of the book on a yearly basis. I'm not quite sure other insurers or other underwriters can say the same thing. And we do want to work with you. We want to work with managers, we want to work with brokers, we want to work with owners. Putting the client's best interest first. We want to stay on risk, as I mentioned. We want to find a solution, whether it's a short-term policy or agreeing action for plan of remediation. But for all of this to happen, we all need time to work with you. So if you know something, don't wait for the renewal to come. Just share that information with us, and we will come back to you and see what we can do for you, and we'll give you enough time. If there is something that we can't help you with or we can't come to the party, we'll make sure that you have at least enough time on your hands to find an alternative solution. For this, getting the support and action of strata managers and OC is going to be paramount, which is very, very important. We want to avoid declinages, often as a result of issues not being addressed, open claims, defects, and lack of maintenance. These are the key reasons why we decline the renewal. Look, providing support and educational materials is something that we want to do a lot more, and hence the reason for webinars every month. And if there are other things that you need to make your clients understand, please discuss this with your BDMs, and we will make sure we provide you as much support and as much educational material as possible to make your life easy and make your job easy. And being responsible and accountable is what we do. And as I said, we've been in the market for 45 years, and the last couple of years is probably the toughest that we have seen as a strata industry, and especially in my 14 years at CHU, last couple of years has been the toughest that I've come across in a short insurance career, and I don't see that going away in the next couple of years. So we need to work as a team to make sure we provide as many solutions as possible for our end clients. I did touch about the support services, so we are kind of trying our best to make sure we do support our customers in offering multiple new services. So our on-site loss adjusting and assessment expertise, CHU Assess. This is not a typical loss adjusting company where a loss adjuster will go, an assessor would go, inspect the damage, do a report, send it back to the underwriter or insurer, and then they send him instructions, and then things happen. That's not what CHU Assess is all about. CHU Assess are loss adjusters with claims authority. They go out, they inspect the damage. If there is something that is covered, they take a decision, they engage a contractor on the spot, and claim gets done. We started in 2016 with one loss adjuster as a pilot in Sydney. No, I can't remember how many we do have. I think we have about 5 or 6 only in Queensland. So the numbers are growing, and we kind of, trying to establish and trying to help our clients in consulting with building support for strata buildings as well. And CHU Inspect is very, very, very new, which is a virtual external and internal inspections, which collects critical data collection that helps the buildings. Client's best interest, it's the right thing to do. It's a win-win situation, and they will thank you. Those conversations are not easy, but trust me, that's the right thing to do. And that is the end. Thank you so much for your time, and have a great day.